Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.
Welcome back to Sparta Market Outlook, your weekly snapshot of what's really driving the global oil markets. So we've got some returning faces this week with James back from a month of paternity leave. Hi, James.
Hi, good to see you again.
Good to see you back, James. And Jorge, who's back on the pod following a week of well-earned vacation. How you doing?
Hello, Rachel. Yeah, very good. No new kids around here. I've just been on holidays.
Brilliant. Okay. And we've also got Neil on the pod as usual. Hello, Neil.
Hi.
Brilliant. Okay, so this week there's been big moves in geopolitics yet again. So with India, China and Russia steadily solidifying into an energy bloc. Meanwhile, physical markets are shifting rapidly with diesel spreads spiking on the news of a big Pernis turnaround, naphtha spreads gaining on supply outages, including from Luga, and gasoline cracks also on a tear. Geopolitics premiums are returning to the crude market too, so we'll cover all of that. And what with APPEC around the corner, think of this episode as a warm-up pack of chat-up lines for next week's speed dating for traders. So the stories, the spreads and the sound bites that you want in your back pocket when the networking starts. I'm your host, Rachel Williams, and Neil, I think you're going to kick us off again today with some chunky segment on headlines and fresh data sets.
Yeah, I'll try and keep it relatively short, but a lot happened, and obviously guys feel free to chime in. But I was going to start by saying, look at flat price, that's gained a lot over the last couple of weeks, and it has, but the last 2 days or last day was relatively bearish, and also for spreads, and that was the news that OPEC, or the rumors, let's say, that OPEC are considering upping supply again because there's another meeting at the weekend. And there was also the kind of more rumors about Putin getting ready to meet Zelensky. So all that stuff's in the driving seat. Just quickly on the OPEC side, I think a lot of the market actually had expected that they will stick because they've brought back a lot of official supply anyway, some of which is real. And you know, one thing I want to pick up on was there's all this kind of stories about the Saudi budget in trouble, and they're back selling more international bonds this week. And it's just something I'm not quite sure what the logic would be of ramping up supply a lot more from here when price is already not ideal for them.
Yeah.
There was a logic to bringing back more supply at the start of this year. Prices are relatively strong, and they thought they could do it, and it was kind of proven right. But I don't know what the logic is beyond here, other than the other thought from the market that the Saudis are so in tow with Trump that they will give him what he wants.
Yeah.
I don't know where that goes, but that's just those are the two sort of things pulling in different directions. And there was a bit of confirmation, I guess, if you like, which might have been more, how do you say, performative, which is that the Saudis and the Iraqis are not going to ship oil shipments to Nayara, the Nayara refinery. So again, that might just be performative. It's not a big thing for them, but it goes in the same direction. The other thing that was bullish, or I saw it as bullish, is Modi and Putin and Xi and also Kim were meeting at the weekend, right? So they are cozying up essentially. And what I saw was bullish was, okay, it was initially bearish that India is not rejecting Urals, but then comes the next step is like, what's the US reprisal going to be? Because what does the US do now? Trump has essentially been made, I would say he's been made a fool of over the last week. And I think that's still relevant. It should be keeping the market up at night, so to speak, with regards to like what's next? And if it wasn't for the flat price and the OPEC headlines, Dubai was, or the spot Dubai market was actually pricing like that as well. Sort of fear of reprisal, I would have said. And there's other things going in that direction. The Power of Siberia pipeline thing did the rounds. That was like turning heads yesterday. There's the Chinese clearing up Urals. That's the main thing that is going to give us a bit more difficulty making any calls on the Dubai market over the next week or two, I would say.
I think this is going to be a pretty hot topic as well going into APPEC next week. So it'll be good to get kind of some feedback back from the events that we've gone to. But we've heard nothing back from Trump, right? This week off the back of last week's meetings.
No, there was some sort of vague statement yesterday about sort of whether or not he's going to reduce, he's not going to reduce the tariff on India. There's some vague statements, but it wasn't very market moving. But more is likely to come.
Yeah.
And in the background there's also, again, it's all related to Ukraine as well, of course. And there was the thing that's more relevant for you, Jorge, which you'll pick up on later. I don't want to sort of jump the gun, but Ust-Luga is really quite impacted by these attacks, right? The news was that it's going to function at 50% in September, and that you can talk about that impact on naphtha, but that's really substantial, and more of that can also happen. Oil infrastructure is very sensitive to these things. It's so easy to take it out.
Yeah. It's something that we will address later in NAFTA, but it's a big deal for Asian balance. Looking at October and looking at the Ust-Luga exports, it represents 35-36% of the export from Western origins into the east of NAFTA. So definitely it's going to have a strong impact.
Why don't we move on to just one piece of data that came out? So that was the EIA PSM, which is the monthly data. And there's two bits that are relevant, one for you, James. The first one is US crude oil production supply, and that growth is accelerating. And it's really resilient, and we want to bring this back to why is WTI being so cheap over the last month, and that's definitely part of the reason. And it has not really done what the market has kind of expected, or at least part of the market, including us, I guess, right? We sort of thought the price would impact US supply, and so far it's not. So that's something to keep in mind. And related to that is things like the rest of non-OPEC supply. So Brazilian supply has jumped a lot higher over the last couple of months. I think it's up 800 kbd year on year now in July. It's big, and that impacts the market. Yeah. And so some of these things are being realized, and Guyana is starting up a new field. So, there is a decent chunk of supply growth still coming out of non-OPEC. And the other interesting thing was the diesel data, James. So fossil diesel demand in the US is growing really strongly. It was really bullish in June, and again that's counter to the narrative, and part of the reason appears to be a bit of a weak reading last year for pad 1. And remember, it's not really winter, it's June, it's not a winter effect, so that's partly normalized. But the other thing is that the demand for biofuels, biodiesel, renewable diesel has dropped away, and so it's partly a replacement effect. I don't know if that's to do with poor plant margins. I had a quick look into actual supply. Supply also dropped, so maybe there's just a supply issue. But it's definitely a slightly different story to what we were thinking about a few weeks ago. It's not just yields. There's also decent demand that's keeping US stocks low, if you like, or lowish, or had been keeping stocks low. Yeah. And one more on that, the yields side, actually the monthly yields over that time frame were higher than the weeklies would have suggested. So it's not just like a lack of supply, it's actually more of a demand story than we thought, which is kind of a slightly different narrative, actually.
Okay, I think that's actually Yeah, that's quite a nice segue, actually. James, I'm going to come to you first then in that case and get your take on diesel. So look, pricing had been in a bit of a lull. Welcome back, by the way. I hope you've kept abreast of kind of the distillate market while you've been off.
I tried my best, yes.
Good. Very proud of you. But look, things look a little bit brighter now. Obviously, kind of off the back of Neil's comments as well, what's driving kind of the market this week?
Yeah, a bit of a lull. So yeah, I guess last time I was on the podcast, we had like kind of bit of a bearish feeling in the prompt, and I guess that kind of manifested a little bit in ICE gas oil spreads. But yeah, over the last few days, we've had the news about Pernis turnarounds, and they could probably be up to like 6 to 8 weeks long, and we've seen a decent impact from that on ICE gas oil spreads, well, spreads globally, really.
Yeah.
So as a kind of consequence of that, but also before that as well, actually, there's a large number of arbs open into Northwest Europe, into Rotterdam. Interestingly, the MR arb from the US Gulf is closed. We're going to speak about TC14 freights later, but actually LR2 arbs on diesel and LR arbs are open from the US Gulf into Northwest Europe currently as well, or into Europe in general as well. And swing Middle Eastern diesel arbs are just very open into the West, if you kind of compare them historically, and particularly if you compare them to like east-facing arbs, basically. I think when I heard the podcast last week, you'd been discussing that maybe there's been quite a bit of a step change in the S&D in Asia, and maybe that's something we need to look into more over the next period of time. But I think we should really be interested probably in the effect of the spreads maybe further down the curve. It does feel like the market isn't super relaxed about the amount of diesel that we've got in stock currently in the state of the S&D. Like one side note is kind of like on the US Gulf, LATAM side. We've seen like a lot of yield gains in the US, as Neil was kind of to speak about just then, and stock gains as well. But a large amount of this has been in PAD 2, where stocks were super low before, rather than kind of PAD 3 US Gulf. And again, another important note, and something that Neil alluded to a little bit as well, is that we saw Russian diesel was only down by about 6% month over month in August, according to the headlines at least anyway. Although the continuing effect of these refinery attacks shouldn't be underestimated. And maybe it is something that is manageable, and Brazil can still get what it needs from the US Gulf as seasonal demand peaks there in Brazil as we move into like harvesting season towards October. And really, I guess I gave away the punchline a little bit, really, but the US Gulf arb, really what's closing at the moment is kind of those high TC14 freights. They're even kind of crimping the arbs into the Brazil currently as well. And surely we've got to see these TC14 freights come off over the next period of time, and again open up this US Gulf arb into Europe. I'm just going to roll on. Sorry, I'm going to speak a bit because I've been on the
absolutely.
pod a while. Yeah,
I can go with it and add something though, James. Just I think the sort of key thing of that segment is that at the moment freight is its own kind of, let's say, thing, and we see TC14 coming off, and the last couple of days vessel supply in TC14 is actually ramped up, so that makes our forecast drop off even more, even though we've seen some correction. I think my impression of the state of US balance is, if you look at PAD 3 diesel stocks, they're not super glutted, they're not super low. It just feels like, maybe we can just round this off and say that what do we think about the HOGO? It still seems like, you look at the LR2 arbs, they're kind of open to Europe, but we're just about to approach winter, we're just approaching turnarounds. It feels like the HOGO can still be a buy. Is that where you see it? I think
kind of. I wanted to summarize that at the end, but I think both the HOGO and don't worry, don't apologize. That the HOGO and the East-West, I think, are both a buy from here actually. And it's interesting. So we spoke about the kind of the change in the Asian S&D. That we wanted to maybe do some more investigation work into. But interesting things like Ulsan VLCCs are open into Rotterdam according to our ARB calculations. And we've already also seen 2 VLCCs on the water heading to Europe from the Middle East currently as well. Now, I didn't want to speak over you, Neil, but I'll kind of go into like kind of maybe my kind of trade views now.
Sounds good.
I think that in general, I have a bullish view on global distillate.
Yay! I'm so glad you're back.
Yes.
And what's and
there it is.
The main driver for that is that stocks, as Neil's been kind of to point out, aren't particularly high, although they have moved back into a normal range over the last kind of month or so. But They're reasonably low. And we've got global maintenance coming up, pretty heavy in west of Suez particularly, but also in the Middle East. I think there is an argument for some short-term bearishness in probably ICE gas oil spreads and cracks and European jet. I think that's a very short window for that, but I mean, where have we got the front spread now? I think it's at 7 plus 750. I would be selling that towards expiry probably. But we have, adding to that bullish picture, we've got probably chance of supply disruptions rising. So Russian diesel exports, Ukrainian attacks, we've kind of spoken about that already. The US response to India, as it were, and also kind of the continuing rumors that are becoming more substantial about kind of low Chinese distillate exports as we head into Q4 because of low export quotas as well. And adding to that kind of bullish picture as well, and kind of Neil's kind of spoke about it, we've got the concerns about US diesel demand seem to be easing as well.
Yeah.
So yeah, short-term bearish European pricing, a really short window. I'm talking about up to like September expiry next week, medium to long-term bullish. Thanks very much.
So a few trading sessions to get that right. Let's see.
Yeah, very much looking forward. Also, we'll pick up on kind of the Chinese export quotas story as well next week, I'm sure, kind of whilst we're in APPEC. Lovely to have you back, James. Jorge, you've been absent for a little while as well, and I genuinely hope that you've been kind of laying on a sun lounger, reading all about kind of the gasoline market and probably sampling kind of all sorts as well to go with it. But look, the naphtha market has been volatile during the summer. Then we got some supply risk. We had an organic chloride story as well. So what's really driving the Asian naphtha tightness just now, do you think?
Yeah, I think we have had a very interesting summer in naphtha. Looking backwards and at what point we have seen a very strong uptrend in cracks. Also in East-West, we are seeing historical seasonal high levels for East-West in Q4 and Q1, and also for 5 consecutive weeks in a row, we've seen the cash in the East climbing. The main reason behind that, first, there is a structural one. In October, we always have this strong naphtha arbitrage picture because there are many refineries turnaround, and the crackers used to increase its runs during August and September, and then they have the turnaround season later. So we have this. This is expected, but this year, Middle East, especially Saudi Arabia, turnaround season points to be stronger than usual. So we have tightened naphtha markets, and we have feel it since October, first half of October, started to be the prompt for deliveries into Asia. So yeah, this is kind of like the structural picture, but then we have several more bullish factors that have been impacting the market recently. The main one, we have already talked about this, is Usluga. So this means less naphtha is going to reach Asian outlets from Russia, and Asian players need to increase their imports from Western outlets, either Europe or US. So that's one of the main reasons behind the strength in East-West and customs. And then we have an already tight picture from the supply side. But then we have gasoline joining the bullish party. So we have Pernis and Dangote news this week. We've seen a very strong rally in Western gasoline and a very strong downtrend in East-West gasoline as well. But overall, the impact on naphtha is that gas naps has been trading higher in every region, improving blending economics. So this improves the outlook for naphtha blending, and it's also tightening that point of the demand. So overall, the picture is bullish as we enter into Q4.
Genuinely thought that kind of we would have a bit of a reprieve from talking about Dangote week on week, but obviously kind of that headline came out earlier this week and we're back at it again.
It can change very quickly, but I think that the market is supported for October. Maybe there is a potential stop when we start trading November. Asian deliveries. But so far, I think that for the next month, the market is well supported.
Right, naphtha East-West then, Jorge. Naturally went higher after Osluga news in particular. What are your thoughts around this going forward?
Okay, yeah. Focusing on East-West, as I have said before, it's a historical high for Q4 and Q1, and we've been talking about a higher arbitrage needed from west to east. We've been tracking it in our tool. It looked open since end of August 25 more or less, for Algeria and for Greece. We have seen 3 cargoes already confirmed from these origins and another 3 cargoes from Med. So Asian traders are getting its products from the west, as it was expected, and we expect a strong picture from the arbitrage perspective during the next month. Apart from the strong AG turnaround season, apart from Russia, there are news about a potential turnaround in Algeria for splitter. It's just new. This is not confirmed, but it will help to tighten the market even more, because Algeria is the main provider from Europe, main provider of naphtha from Europe to the east. So if it goes into a turnaround in September, it could, a higher East-West and higher castics in the east would be needed to cover the naphtha demand for Asia. Yeah, and we can move on to gasoline if you want, Rachel.
Yeah, that'd be amazing. Thank you.
Okay, so let's start linking it with naphtha story. We've talked about strong blending margins in every region. In Europe, E10 has been open for a while. E5 has joined after the last uptrend in Gasnap. E-grade is also open in US, and we are seeing it marginally open for Singapore 92, also in Singapore. That means a strong economics to blend naphtha, so we expect blending naphtha premiums to increase in the coming weeks. We are seeing it already during the last sessions. And from the gasoline perspective, that would be a very picture, because more product stays locally with this blending margin open, and less is exported. But the picture is not that bearish on the gasoline side. We come from a strong uptrend. We have Pernis, we have Dangote in the west, and we have ARA stocks at yearly lows. And apart from that, the picture from the arbitrage, I'm going to link it to James' comment about TC14, but the picture is also bullish, because ARA, in a moment with lower stocks, is priced into almost every outlet in the west. TC14 strength is making US Gulf exports very expensive, so ARA is reaching Latin America much cheaper than US Gulf Coast. So this picture, if we combine the blend margin open and this the refinery turnaround season, and also this arbitrage picture, I'd say for the short term, the picture is moderately bullish if we combine all the factors in the Western gasoline markets.
Okay, so might be a perfect storm then in West to Suez there, but Eastern gasoline is a little bit different, right?
Yeah, it's a little bit different. We have seen a very strong downtrend in East-West as well. And Singapore, also AG, but maybe more Singapore, looked like the complex world was very well supplied during recently. So the strong uptrend has been seen in the West, and we've seen a moderate uptrend, but less pronounced in the East. AG components and Singapore ones were very cheap. So we've seen the opposite trend than in the West. Right now, I was checking this morning, we are kind of seeing a rebound already in Singapore. And I think that the main reason we can find it not just in the turnaround season, but in the arbitrage. If we look at the arbitrage from Singapore, it was cheaper than US Gulf Coast into Mexico, Rosarito. But right now the difference is huge. And it's also landing quite cheap into Nigeria on an LR1. It does not have to say that these trades are going to be confirmed, but it's just it helps to measure the competitiveness of Singapore and the at the bullishness that it can cause in the components in the east. So we also have possible lower Chinese exports that are going to tighten east of West balance. So overall, the picture for gasoline it has been, and the outlook is less bullish than in the west. But let's see, because we are going to enter into October arbitrage, and it can tighten the picture.
Okay, so you're kind of jumping on James's bullish bandwagon. Neil, have you got any thoughts kind of on this?
I was running through some of our seasonal charts whilst you guys were talking, and it was just kind of, I mean, it's not something that's new, but if you look at some of the seasonal charts, if you look at ice gas oil spread seasonals, if you look at EBOB seasonal charts, to a certain extent naphtha, you don't get the impression that it's a really loose product market, right? And it's the same thing with the indicator margins we have. It doesn't feel like the market is ready to bid this thing down in a very relaxed way. I think, James, you said that as well. The market isn't fully relaxed about the state of supply and demand if all it takes is a surprise maintenance and you see spreads massively blow out again. I know ARA is there's particular like price basis risk in ARA when something like Pernis goes off. But it doesn't feel super bearish like the way that products are pricing at the moment, and it's a good segue for crude as well, because it's another signal that's kind of bullish crude, particularly in a place like Europe. Despite the fact that we've got turnarounds, you've got margins spiking. It just doesn't feel super loose. I guess that's my point.
Fair. Okay. Well, Neil, look, you went into kind of part of a crude chat there, so let's kind of move forward to that. So last few weeks we've talked about Brent Dubai, the Dubai conundrum, North Sea weakness. Also kind of keen to kind of pick on the margins bit a little bit more as well as we work through this. But how is the crude market fared, and any new thinking from the team on any of the problems that we were talking about last week as well?
Yeah, I'll just round up on maybe focus on the North Sea and TI just now. So I think last week we talked about the sort of mini bull case for the North Sea, and I think that was working out in terms of FOB premiums. The last day or two has been a bit tricky because it responds obviously to flat price selling off and Brent spreads sold off as well. And from what I can see, the sort of bids and offers in the North Sea are a bit messy as well at the moment. But I do think the North Sea is not quite as weak as it's being talked about in headlines just now, looking at the FOB premiums, for example. And I think from that perspective, there's actually more to come. So we've talked about the ARB signals a lot. The ARB signals are still quite extreme. So 40s is, we've got this new signals dashboard. 40s is still a 10 almost everywhere. And 10 is from 1 to 10 on the scale of too expensive, too cheap. That's the maximum cheap it can be. And, eventually that will start to work its way into pricing. And I think it's partly happening. And the other 2 points to that is that we're now at the weakest point of European buying, presumably, because the sort of dated window is moving towards October dates. And that is presumably the peak of European maintenance as far as we can tell.
Yeah, sure.
So that'll be over soon. And then you have buying coming up again. You've got margins rising into that. You've got ARBs open to the east. And the other thing is that TI has been quite expensive into Europe for a week or two. And that presumably will help. I mean, that's designed to help the North Sea rebalance, right? So presumably it will help the North Sea in the short term as well. So I still see there's more upside to the North Sea from here. I don't think it's as weak as is being made out. Okay. And the other thing to talk about is we talked about the relative cheapness of WTI, and we're just thinking about what can help to solve that just now, particularly in the context of massively expensive Middle Eastern crude still. And there are some things that can help. One of the ones we were talking about internally is the blending of WTI and high sulfur straight run fuel oil, looking particularly at the decline in pricing for HSFO over the last month. So just look at cracks, for example, that's come off massively. And that is one of the things you can blend these two things up into a kind of Arab light quality and run that in your system. And, one of the structural changes about Asian demand for WTI over the last few months has been the Exxon upgrader, for example. We understand, or June was telling us internally, typically with these things, when you run a new unit, you want to keep the diet the same for the first 3 months for warranty reasons, and after that you can start to experiment, which would point us towards the November window for experimenting. And it's not specifically about Exxon just now, but you do tend to find ways of making use of cheap oil, and WTI is cheap and HSFO is cheap. So let's see. The other thing is Dubai, right? So the other thing we've been thinking about is Dubai. It's okay. So the conundrum, I guess, continues, and at the start of this week, spot premia actually soared again, but then it kind of deflated. The spot premiums in the Middle East deflated on the OPEC news and the flat price news, presumably yesterday. I just want to pick up, very quickly. The ARB signals are still max bearish for the Eastern market, so everything can ARB into the East. We wonder, there's two sort of risks still. The first is, I just want to keep banging on about this because I'm getting pinged by multiple people through the week. Oh, look at the state of Middle Eastern exports. They might not be maxing out in September. And lo and behold, that's what you should be talking about, because what are the incentives to completely deflate this market? And the other risk is obviously what we picked up on at the start of the pod, which is what is the US response to the India situation now? And that's the key risk. Actually, the EFS has started to re-widen again over the last day or two with the flat price coming off. But it's a key risk. I can't call it, but there's still a lot of supply risk out there, let's say.
Yeah. Okay.
Yeah.
We'll feed back on that kind of after next week's APPEC. But look, I just want to kind of round out very, very quickly, just in terms of going into next week's kind of going into next week's APPEC week. What are the key things that you guys are looking at? So if I was to be studying a networking session, what are the one or two trades that you have some conviction on going into next week? So Neil, can I run back to you with crude, giving Jorge and James a bit of thought?
Fine. The most convincing one remains for me the North Sea, for the reasons we've discussed. I think seasonally it's at its weakest point. The arbs are open, and TI has been expensive in Europe. So for me, that tends to speak for a little bull case. I think I said that over the last 2-3 weeks, and I was a bit too early with the initial call, but I called it again last week, and it did start to. I'll just go again. North Sea.
Brilliant. Okay, double down. Second question for you, Neil. If there was one thing that you'd like me to ask somebody during APPEC, what would it be?
Well, the one obvious one is, why do you think Dubai can persist at such expensive levels? Okay. How has, for example, the ARB between West and East not completely tanked Dubai over the last month?
Fair enough. I will do my best and I will report back next week. Okay, Jorge, on the light dens, one thing that you're convinced going into next week, and also you're joining me in APPEC, so the one question that we'll be asking people during the week as well.
Okay, so about the positions, I overall see some risk on short positions in the light debt complex right now. But maybe the one that I'm most convinced is on a stronger time spread for naphtha, because we've seen a very strong uptrend in cracks and in East-West. But I think in time spread we have some room for higher levels. So that would be about positions and about questions I want to ask in Singapore, and I will ask. We've been reading a lot about the strong turnaround season in the G, but I'd like to ask more in detail in there, because maybe most of my bullish ideas are based on that. So I would like to talk with players around there to see their opinion.
Brilliant.
Yeah, I wanted to ask that question as well. That's a good one. Yeah.
That's right. We can double down. So.
Yeah, and mine. Well, the trade I've probably got the most conviction on is the East-West as a buy, I guess. Second to that, the HOGO as a buy. My question to ask is, we saw large turnarounds last autumn because refinery margins were so poor, partially, and refinery margins are so strong now. I would expect these turnarounds to be weaker or lower in amount coming into autumn. So,
or crude runs will be higher. Utilization will be higher in the plants that are not offline. That type of thing as well. Yeah.
I think it's pretty hard actually kind of to defer maintenance, if I'm honest, because the amount of work that goes into planning, rallying, and also just on a technicality, you need to kind of shut down some units within a certain amount of years because they become inefficient. So, but it'll be a good one. It'll be a good one to kind of check in on. I do expect, as Neil said, utilization to be higher though, kind of given where margins are for those that are still online. So one to watch.
Yeah, the reason I want to ask it is because it seems like a lot of our calls now are based upon the fact that we're going to turnaround season. So the magnitude of that is really important to us. So, sure.
It still seems sensitive. It goes into the way that what we said earlier, right? But if you look at the chart of total US product stocks, they're once again below 2023 levels when the market was still in panic mode. So something about it is not ready to change. We've been calling I think we've mentioned a few times over the last few months, oh, look how strong margins are. Surely this will knock off the product market, but it never does. It's tight, and maybe that's because demand is just not falling.
Yeah.
In the way that we expected.
Yeah. Fair. Demand question for me then for next week. Okay. Well,
and sorry, one more. Sorry to drag us out. One more is refinery capacity. And because we mentioned Dangote and Dos Bocas has been offline for the last week as well. These are refineries that have a crap track record. There's no other way to say it. They keep breaking down, and we've replaced multiple refineries in the US and Europe with these refineries, and these things keep breaking.
Yeah.
So, of course.
Net, kind of, you're probably running lower on capacity than kind of what you were before. Okay, yeah. Well, yeah, one to chat about. Okay, well, look, guys, in the interest of time and our listeners, I think that's going to be a wrap for this week's edition of the Sparta Market Outlook. So, look, we've journeyed through everything from tight naphtha markets to geopolitics hotting up again, and distillates in Q4 gathering momentum. Thank you very much, James. Glad to see you back on the bull wagon.
Thanks.
If you're stuck with us through the chats, the chaos, the bullish views all around, you've earned your Market Gladiator of the Week badge. It's virtual, but the pride is very real. So as always, we're all ears for your feedback, your trade ideas, or your spicy rebuttals to anything that we said, especially if they come with a chat, a meme, or a well-placed jab at Neil's tea leaf readings. We're going to be back next week from APPEC, hopefully same time, maybe same volatility, with a bit more insight from the questions that we'll be asking people. We'll also be at the Sky Bar on Monday evening. Please come and join us and say hello, but also our breakfast briefing on the Tuesday morning as well. Again, you're welcome. So until then, keep your hedges sharp, your barrels balanced, and your inbox tuned in for the next drop. That's all for us. Thanks for listening.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.